Hey everyone, let's just get right into it. Today we're tackling a topic that, let's be totally honest, makes a lot of real estate students completely break out in a cold sweat: math. Specifically, we are going to demystify real estate tax prorations. By the time we wrap up this explainer, my goal is to hand you a bulletproof, repeatable framework so you can absolutely crush these proration questions, whether they're on your exams or sitting on your desk in your actual real estate practice. No more guessing, just straight up logic.
But right out of the gate, we need to make a really crucial correction to how we even think about this. It is absolutely vital that you lock this in. So sometimes you're going to hear people, or you might even see practice questions, talking about a property tax refund. Right now, I want you to literally strike that word from your vocabulary. We are calculating settlement prorations. The government is not, I repeat, not issuing a tax refund check here. We're simply figuring out who owes whom at the closing table, just to balance the scales. It's really just a debit and a credit between the buyer and the seller on the settlement sheet. Oh, and also for our standard real estate calendar year, because we assume 30-day months, that year runs from January 1st to December 30th.
Okay, let's dive into this by laying out our foundational ground rules. If you're taking the national portion of the exam, you've got to memorize these default assumptions. Unless a question explicitly, and I mean explicitly, tells you otherwise, you just assume every single month has exactly 30 days. So naturally, that means a standard year has 360 days. And finally, the golden rule of ownership. Always assume the buyer is responsible for the settlement date. The second the calendar flips to the day of closing, boom, the buyer owns the house, and therefore they own the tax liability for that specific day.
To completely rescue you from those super common calculation mistakes, we're going to lean on this 4-step framework for every single problem. Step 1. Always draw a timeline. Seriously, this visualizes who lived in the house and who owes whom. Step 2. Compute the daily tax rate. Step 3. Determine the exact number of days owed. And step 4. Just multiply that daily rate by the number of days. Honestly, if you just stick to these 4 steps, you are never going to get lost in the weeds.
So let's put this framework to the test, exactly how you'll see it on the exam. I'm going to read the whole question out loud for you. Here we go. Real estate taxes are assessed on a calendar year basis, but are payable in one installment on July 1st. The annual taxes on a particular home are $1,890. If the property sells and closing is on April 17th, what is the settlement sheet entry for the proration of the taxes? And this brilliantly illustrates exactly why step 1 is just so important. Let's look at the timeline. The tax year is a standard calendar year, right? So it kicks off on January 1st and ends on December 30th, based on that 360-day rule we talked about. Closing is sitting right there in the middle on April 17th. Now here's the kicker. The taxes aren't actually due until July 1st. That means the seller basically lived in the house from January through mid-April without paying a single dime in taxes for that year. But because the buyer is the one who's eventually going to get hit with that full tax bill in July, the seller has to hand over some cash to the buyer at closing to cover the days the seller lived there. Long story short, the seller owes the buyer. All right, moving on to steps 2 and 3. First up, we need to find that daily rate. We just take the annual taxes of $1,890 and divide it by our standard 360-day year. That pops out a nice, clean $5.25 per day. Next, we've got to count up the seller's days. Remember our rule, 30 days in a month. So January, February, and March, that gives us 90 days right there. Now for April. Closing is the 17th, and our golden rule states the buyer owns the settlement date. Therefore, the seller only actually owned the property for the first 16 days of April. 90 days plus 16 days gives us exactly 106 days that the seller is on the hook for. Finally, step 4. We multiply. We take those 106 days, multiply them by our daily rate of $5.25, and that equals $556.50. So when you look at the settlement sheet, the entry is going to show that the seller pays the buyer $556.50. Think of it this way. The seller is essentially handing over their chunk of the tax bill in advance just so the buyer doesn't get stuck paying for the time the seller was living there. It makes perfect sense when you actually map it all out, right? All right, let's step it up a notch. Here is the full text for a slightly more complex scenario. The property tax year runs from July 1 through June 30, with the full payment due on January 1. The practice in the state is to use actual days and 365-day years. Also, the common practice is for the seller to be responsible for the taxes on settlement date. The sale of a home closes on January 15th, after the seller had paid the annual taxes of $2,377. What entry will be made on the settlement statement for the tax proration? Now, what's really interesting about this slide and this specific exam question is how it completely flips our golden rules upside down. Because look,
In the real world, and especially in state-specific exams, the rules can and do change. We're no longer using that 360-day assumption. Now we actually have to use the real 365 days. And this is absolutely critical. The question specifically tells us the seller is responsible for the settlement date, not the buyer. The major takeaway here, when a question gives you new rules, you absolutely must obey those new rules.
So, back to step 1, let's draw out the new timeline to figure out this mystery of who owes whom. The tax year here runs from July 1st to June 30th, and closing is sitting right in the middle on January 15th. Now, the question notes that the seller had already paid the full annual tax bill back on January 1st. I mean, they prepaid for the entire year. Since the seller paid all the way got to June 30th, but they're packing up and leaving on January 15th, the buyer is going to be moving into a house where the taxes are already totally paid up. Because of this, the script is flipped. The buyer has to reimburse the seller for the remainder of the year. Let's move to and see how this builds to our final calculation. For the daily rate, we take that $2,377 and divide it by 365 actual days. That gives us roughly $6.51 a day. Quick pro tip for you, leave that unrounded number in your calculator for the best accuracy. Okay, now let's count the exact days. The seller owns settlement day, January 15th, so the buyer's responsibility kicks in on January 16th. January has 31 actual days, minus the 15 the seller owned, leaving 16 days. Then we literally just add up the actual days for the remaining months, February all the way through June. You add those all up, and the buyer owes for exactly 166 days. For the final step, we multiply. Taking those 166 days and multiplying them by our daily rate of $6.51 brings us to a super satisfying resolution, $1,080.66. So the settlement statement entry is going to show the buyer paying the seller this exact amount to reimburse them for those prepaid taxes. Do you see how powerful that timeline and step-by-step approach really is? It's like a mental anchor. It keeps your math completely organized, regardless of what crazy rules the question tries to throw at you. So, the absolutely crucial point here is this. Always follow the steps, always draw that timeline, and always watch for rule changes hiding in the text. Which actually leaves me with a thought for you to chew on. How might a leap year, throwing February 29th into the mix, or maybe a really specific local county rule, completely alter the financial outcome of your settlement sheet? It just goes to show why knowing your local regulations is absolutely critical. Check your state-specific guidelines, keep practicing those timelines, and I promise you'll be mastering prorations in no time. Thanks so much for joining me on this explainer.